What is going on, investors? Hopefully you guys are doing well out there. That is right. Earnings season rolling right along, and we've got an important company today. We're going to be taking a look at Meta Platforms. The company reported their Q3 earnings after the bell. We'll take a look at the spectacular results just year over year. Everywhere you look on the financials, it just paints a completely different story from a revenue perspective, from a cost control perspective. Things are looking really good at the core business. We've got to talk about that all-important metaverse pivot that this company attempted to make. Seems like they're more back on track with their core business. We'll talk about the guidance for the upcoming quarter as well. We'll compare that to where Wall Street was. We'll also give you just a sense of where expectations were for this company just a year or two ago. We'll talk about how those expectations have just been drawn in from the market, and if this company can get back to that level. We'll also talk about this from a technical perspective. Like many stocks during the regular trade, Meta got hammered down about 4% in the after hours. I am seeing shares tick up by about 2%. So still, over the past 24 hours, shares of Meta are dipping, but over the past year, shares of the company up 117%, year to date up 150%. So the fact that this company and many companies out there have to take a breather after that type of move definitely makes a little bit of sense. We'll make sense of these Q3 numbers, which again came out after the bell. $34.15 billion worth of revenue. That was 23% growth year over year. Just shows you how bad the ad market was, at least over at Meta Platforms last year. They beat expectations by about $700 million on this revenue side. High-end Wall Street analyst was for about $34.5 billion. They didn't quite come all the way to the high-end estimate, but pretty darn close. Now, what you're probably wondering is, where is the company going to be for the upcoming fourth quarter? Meta is estimating anywhere between $36.5 up to $40 billion. And this is your marquee quarter if you're Meta, okay? This is when advertisers just do like a fire hose of advertising for products over the quarter. And so 36.5 to 40, it depends on where you come on that spectrum, because the Wall Street low-end analyst for the Q4 for Meta was right there at about 36.5, and the high end was for 40. The midpoint was, we'll call that about $39 billion. So I tell you what, Meta has the opportunity or the potential to really disappoint if it really comes in towards the low end. I'm actually pretty surprised they get this wide of a range for their guidance for the upcoming fourth quarter. It means they probably have some visibility into it, but it's going to be really this like October and particularly the November month where they're really going to have to make a lot of money from the holiday spend. And they obviously are anticipating on the high end estimate that the revenue could come in, but I guess there maybe is some worry that it doesn't. That's why you have this 36.5, because again, in a third quarter, we just put up $34 billion. That's a really strong number. And again, it beat expectations. I'm just wondering why for the next quarter, you're only projecting $2 billion more than that, which is less than a 10% increase sequentially. And again, we're moving into a fourth quarter. Now, the thing to keep in mind, this doesn't just apply to Meta. This applies basically to the entire stock market, is you've had this game by Wall Street analysts. Look, back in January of just last year, Wall Street was anticipating this company to be hitting 41, 43, 45, 47, as close to $60 billion in revenue for the fourth quarter. I just told you the company on the high end, and we'll give Meta the benefit of the doubt. Maybe they're sandbagging a little bit. They're going to come in at 40.5, 41 billion on the upside. Again, Wall Street this time last year was expecting close to $60 billion. So you've had the air let out of the balloon as it relates to analyst estimates on that revenue side. Same thing on the earnings side, although those have been walked back to the previous expectations, largely because of cost cuts, which we'll talk about here in a moment. Last thing I want to point you to inside of the press release is the fact that they noted that ad impressions over the last year across all of their apps was up 31%, but the ad price, so the price per click basically, was actually down by 6%. So what they're doing is they're overloading the platforms with advertising, and they're just getting less per click. Now, in an environment where you don't don't have a lot of, there is competition in social media, right? But when you are the dominant player and people just go back to you because that's what they've been doing for a long time, well, I tell you what, you can get away with this. But after a while, you have to wonder, can you load the products with this much advertising and not turn off their users? Clearly, they didn't see that. They did see growth basically across the board in their monthly and kind of daily active users metrics. So the fact that they were able to increase the ad load by 31% and still see growth in monthly active users, tell you what, that's a good sign for Meta. Now, what's also a good sign is last year you had just $27.7 billion worth of revenue in a quarter, and now you're all the way up to $34 billion. And look at these cost controls. Company did a fantastic job over the last year on a quarterly basis. Look, your cost of revenues barely moved. Your research and development, they're still investing there, but it's basically flat year over year. Look at your marketing and sales. You grew your revenues by 23% over at Meta, and your marketing and sales went from $3.8 billion down to $2.9 billion. They shaved nearly $1 billion off their marketing and sales, and they increased their revenues by over 20%. Just a testament to how the product more or less sells itself. Your general administrative also, this is where you saw the cost cuts. So this company, like every tech company basically, went through a round of layoffs earlier this year. They didn't really cut in that research and development. Where they cut is on marketing and sales and tremendously on G&A, that's where you want to cut. If you're going to cut at this company, cut on G&A. And look at this, $3.4 billion last year down to $2 billion. That is just fantastic. And that's the run rate you want to be on if you are Meta Platforms. Look at your total costs and expenses over the last year. They went from $22 billion down to $20 billion. You shaved off nearly 10% on your expenses, and you grew your revenues 23% at the same time. My God, they need to give some people some raises over this company. This is fantastic. Your income from operations went from $5.7 billion up to $13.7 billion. Absolutely fantastic. Your net income just absolutely soaring. And the fact that this company doesn't have a cloud division like Google means the shares, again, in the after hours are ticking higher. Google painted these same results. It's just their cloud business wasn't nearly as good as expected. From a cash balance sheet perspective, compared to December, it's up quite a bit. The company has $78 billion of current assets. Most of that is cash or accounts receivable. At the beginning of the year, they had close to 60. That's largely because the company did, I believe it was 2 rounds of fundraising. Might have been just one, but they went from about $10 billion in debt up to about $18 billion over the last year. I guess if the money was cheap, I can see why they do that. But based on these results, I actually don't see really a reason for that. You pull down on your cash flow number. Here's our statement of cash flows. Far left-hand column is our most recent quarter. We pulled down a net income number of $11.6 billion. Last year, we were closer to $4.4 billion. Again, just a dramatic turnaround for this company from a cost perspective and a revenue perspective. Adding back in things like depreciation, share-based compensation, deferred income taxes. I guess you got to pay those eventually. Considering the state of the United States government, probably going to have to pay those. The net cash provided by your operating activities, look at this, $20.4 billion. Okay, it's not quite Microsoft and Google-like, where they're close to 30, but this company doesn't nearly have the kind of investments underneath these operating cash flows. Last year, you had just $9.7 billion. I mean, here's the reason why Meta Platforms over the last year is up 117%, because you've more than doubled your operating cash flows, and at the same time, you've slashed your operating expenses by about 10%. And inside of this guidance as well, they talked about how their total expenses for the full year is going to become $87 to $89 billion. The previous range was for 88 to 91. And I believe, don't quote me on this, but I believe previous press releases, they were at a higher range than this. So they've continued to walk back their expenses. They've done a nice job controlling things from a financial perspective over at Meta. Give them credit, because they're really playing that Wall Street game, right? The estimates were way higher not just from kind of a revenue perspective, but really, really high. Okay. Again, Wall Street was expecting 60 billion. Again, this was about a year ago. Wall Street was expecting $50-60 billion in revenue by now for the fourth quarter. And again, the company just told you it's going to be 36 to 40. So the company's done a nice job. Meta's done a very nice job playing the game, keeping the cash flows high, keeping the profits high. They continue to buy back shares in the most recent quarter, but I do respect this, that they walked that back by about $3.6 billion last year when the shares were 100% lower. Or I guess it's not 100% lower. You guys get the math, but the shares of the company were a lot lower last year and they had more of a buyback. So I like the fact that the shares have rapidly increased and, they've decided to pull back a little bit on that buyback, maybe wait for a little bit more strategic opportunity to continue to do that. Now, the all important Reality Labs, the metaverse, guys, is it here? No, it's not. Last year, you had $285 million in revenue. Again, this is a company that is worth $800 billion, $285 million in revenue. They could drop this on the ground over in Menlo Park and, the person that picks it up is going to be happy, but there's not going to be a shareholder of Meta that would actually notice. Look at this. You had a decline from 285 down to 210. That is still not great. They're still going to have to shrink this form factor. And I tell you what, if Meta is able to shrink the form factor to those silly looking goggles down to something like a pair, and it doesn't have to be a pair of glasses. I think we're going to go to like a ski goggle look or those like Brian Bosworth kind of shades that I've seen kind of come back in style more recently. That if you get to that form factor where it's a little thicker, but it's not this big like thing on your face, well, they probably have something there, but right now they don't have it. And you see declining revenues on a 9-month basis and a 3-month basis. It's just showing you there's no demand. There's just no demand for that product. And then you finally come down here to Reality Labs. The silver lining is it looks like we might be starting to flatten out on the losses. So last year you lost $3.6 billion. And then that was significant, okay? When your profit from your core business was 9.3 and you lose 3.7 on a pet project, more or less, one that is declining in revenues, it's not good. Well, luckily now the company's printing $17.5 billion. So a $3.7 billion loss, still not nearly as bad. But I tell you what, if they weren't involved in this, you would have income from operations just even higher. You could do more of a buyback. You could be out there buying media companies, buying some of these other companies that are just in the trash heap. Instead, you're investing in this space where I think at some point the form factor is going to shrink to a pair of ski goggles, which on some people is going to look really, really cool and be kind of attractive. But at that point, Google's going to have their own version. Meta's going to have their own version. Apple, Microsoft, every other company in the world is going to have a product at that point. The first mover advantage is going to make you bleed through $3.5-4 billion worth of operating profit every single quarter. We see for the last 9 months, they burned through $11.5 billion. Guys, that's more than a quarter of their operating profits. It just still doesn't make a lot of sense, but shareholders, for the most part, don't care. Price action on this stock has obviously looked great from the bottoms. Now we've broken through this kind of breakneck trend, and you got to break through those. Okay, the stock isn't a skyscraper; it just can't continue to stand up on its end and go higher. But look, even in kind of the shorter term, you're still making higher lows and higher highs. You'd like for this one to continue to walk higher, making new high up here at 333. You do that, still looks good. You're sitting on an area of kind of support resistance right here in kind of the 300, 330 range. Underneath the stock is a bed of support that goes all the way down to about 250. All this adds up to, I wouldn't be wildly excited about moving into Meta Platform stock from just a technical perspective. But if you want to add to a position or just kind of start a small one, these are areas where it's not terrible, but your upside is likely retesting highs back up here at 380, which again is considerable where you are at now, about $80 in upside, but your downside is back down here to about 250, which we'll call as $40 to $50 to $60 in downside. You have equal risk reward on this one, and you tend to want to see the setups a little bit different. But let's give Meta credit. They've really turned things around from an advertising perspective. They've done a beautiful job of controlling costs. They're still absolutely hemorrhaging money as it relates to Reality Labs. And if they kick that business to the curb and just wait until the trend is ready for them, well, I think they probably could print a lot of money. But in the meantime, they're going to continue to burn through a lot of money trying to become the winner in that space, and I just don't think they're going to be able to do that. Hopefully you guys enjoyed today's video. We'll obviously be back on Friday for the FANG recap show. I believe we have Amazon again tomorrow. It's been a big week, and I look forward to seeing you on Friday. Until then, good luck with your investments.